Welcome back, future CPAs. Nasa second part na po tayo ng share-based payments. Sa first part po ay pinag-usapan natin ang equity-settled share-based payment transaction. In this part, pag-uusapan naman natin ang cash-settled share-based payment transaction. So, nagbigay ng definition yung ating PowerPoint, pero isimplify lang natin yan. Dahil ang gusto lang naman sabihin sa atin yan is yung mga na-acquire ng entity na goods or services is binabayaran ng cash. So, ang obligation is to pay cash. Yung mga goods or services at mga related liability ay minimeasure at the fair value of the liability. I hope that is clear. Isa pa sa mga dapat nating tandaan is at the end of each reporting period and even on settlement date, the liability is remeasured to fair value. So, ang isa pong common example niyan is yung tinatawag nating Employee Share Appreciation Rights or SARS. So, a share appreciation right is a form of compensation given to an employee whereby the employee is entitled to future cash payments rather than equity instruments. So, future cash payments. So, ito yung SARS, no? Equity Share Appreciation Rights. So, another form of a share appreciation right is when an employee is granted a right to receive future cash payment by a grant to a right that are redeemable. Future cash payment, as long it is cash. So, SARS yan. Okay? Punta na po tayo sa measurement. The liability for the future cash payment on share-based rights is measured initially at the end of each reporting period. So, yung pag-measure po natin sa mga SARS is at the end of each reporting period. So, the compensation expense, salary expense on SARS is recognized similar to employee share option. Similar to employee share option. That is, if the SARS vests immediately, salaries expense is recognized in full with corresponding increase in liability at grant. If SARS do not vest immediately, salaries expense is recognized over the vesting period as the employee renders service. So para mas maintindihan natin ito, meron tayo dyan illustration. Sa illustration natin, January 1, 20x1, yung entity ay nag-grant siya ng 1,000 share sa kanyang mga employee. So ang condition, dapat mag-remain sila ng kanilang service within 3 years. So yung mga SAR information is ito. Yan, January 1, no? Date natin. Then yung number of SARs expected to vest at syempre yung fair value of each SAR. So andyan po sa ating table. So pumunta na tayo dun sa next table natin sa paano siya compute, no? Ayan, January 1, 20x1, wala. Bakit? Kasi nga, ginarant pa lang. Then sabi natin kanina, mini-measured siya initially kailan? At the end of reporting period. So ayan, mini-measured natin siya on December 31, 20x1. Bakit? Dahil sa problem, wala namang binigay na end na reporting period. So assumption natin is December 31. So, 900 multiply natin sa 12, which is the fair value niya, and multiply natin sa 1 over 3. Bakit 1 over 3? Unang taon pa lang yan. Kaya 1 over 3. 3 years, diba? Then sa next year, same process. Ang naiba lang is dineduct natin yung salary expense from the previous year. Bakit? Kasi nagamit na natin yun. So, 2 years yung pinupit natin, ibawasan natin yung nagamit natin for the previous year. And ganun lang din sa next. Susunod na taon. Now, yung nasa table, i-journalize lang natin. So, no January 1, 20x1, so ayan, no? Yun yung memo entry. Kasi nga po, binarant pa lang po si 1,000. Now, yung kanyang initial measurement is nag-start noong December 31, 20x1, which is yung nasa table natin kanina, ginornalize lang po natin dyan. At makikita natin sa baba is in-accrued na yung lahat ng salaries payable, which is yung total ng, yung total lang naman po yung lahat ng kinumpute natin starting from December 31, 20x1. Now, this table is important po, no? Kasi dito natin na pagkukumpara si employee share option plans at saka si SARS. So, sa employee share option plans, share options are not remeasured. Okay, clear na agad, no? Kasi si SARS is re-remeasured. Expenses recognized over vesting period are based on the fair value of the share options at grant date. Changes in fair value are recognized in profit or loss. At isa pa sa kanilang biggest na pagkakaiba is si employee share option plans is sinesettle through the issuance of equity instruments. Kay SARS, cash. Okay, clear po tayo doon. Punta tayo sa intrinsic value na alam kong na-meet na natin doon sa first part ng aming video. For this time naman, CPFRS2 nag-provide that share appreciation rights are to be measured at the fair value of the share appreciation rights by applying an option pricing model. Tandaan natin yan, ha? So punta na tayo doon sa choice between equity settled and cash settled. Choice between equity settled and cash settled. So a share-based payment transaction that can be settled either through equity equipment or instrument or cash is accounted for depending on which party is given the right of choice or settlement. So una dyan is the counterparty has the right of choice of settlement or the entity has the right of choice of settlement. So alam na natin kapag yung entity, yun yung business. Yung counterparty, paano yung tumatakbo at saka ano yan. So paano kapag yung counterparty has the right of choice? So if the counterparty has the right of choice to settlement between cash or equity instrument, the entity, ulitin ko the entity has granted a compound instrument. So si compound instrument, alam ko pong namit na natin yan sa bonds payable. No? So i-ano natin. Konting balikan lang natin. No? A compound instrument is one which includes both a debt component and an equity component. Naalala nyo na po. So as discussed earlier, the accounting for share-based payment transaction depends on whether the counterparty is a non-employee or an employee or other providing similar services. So, paano kapag transactions with non-employees? For transaction with non-employees, the equity component is computed as the difference between the fair value of goods or services received and the fair value of debt component at the date the goods or service as received. So, parang ganito lang yan, no? May reassemble niyo yung basic accounting equation. So, si fair value of goods or services, nire-represent siya ni asset. Then, si debt component, fair value nun, is liabilities. Hindi, yung tira, automatic equity na. So, meron tayong example dyan. If the goods or services acquired for a non-employee have a fair value of 100, our asset, while the cash alternative has a fair value of 80, liability, so yung equity component niya is 20 pesos. Now, punta naman tayo doon sa transaction with employees. Okay, measures the fair value of the compound instrument and its component as follows. So, ito yung idea, guys. If the fair value of one settlement alternative is same, if the fair value of one settlement alternative is same as the fair value of the equity component is 0. So, kapag same sila, no? Yung equity component is 0. Now, kapag different or differ, well, dapat greater than 0. I hope that.
So next would be settlement. On settlement date, the liability component is remeasured to fair value. If the entity settles the transaction in the form of equity instruments, where the liability is transferred directly doon sa equity as consideration para dun sa issuance of the shares. And cash, of course, the cash payment is applied as settlement of the liability. So yung previously recognized na equity component will remain within the equity regardless kung anong settlement option ang napili. However, a transfer within equity may be made like for example, yung pagka-transfer ng balance ng share premium, share options outstanding account doon sa share premium na general account. So let's have an example where the counterparty has the right of choice. On January 1, 20X1, ABC acquired equipment with a fair value of 120,000 from XYZ. On account, XYZ is given the following choices of settlement on December 31, 20X1. Receipt of ABC's 10,000 shares with par value of 10 pesos per share, or receipt of cash payment equal to the market value of ABC's 10,000 shares on December 31, 20X1. ABC's share have a market price of 11 pesos per share on January 1, 20X1. So here ABC has issued a compound instrument because the right of choice on settlement is given to the counterparty. So the fair value of the equity component is computed as follows. So the fair value of equipment, that would be 120,000 pesos, less the fair value of debt component from January 1, 20X1, which is 110,000, because 10,000 shares times 11 pesos. So the fair value of equity component would be 10,000 pesos. The journal entry to record the transaction would be debit equipment of 120,000. This is the fair value of the asset received. and credit accounts payable of 110,000, which is the fair value of debt, and credit again the share premium, share options outstanding of 10,000 pesos. So we have two scenarios here. So on scenario 1, the XYZ chooses equity settlement. So the liability component is remeasured to fair value on settlement date as follows. So the fair value of that component noong December 31, 140,000, 10,000 shares times 14 pesos. Fair value of that component noong January 1, 20x1 would be 110,000. Ililess lang po natin yan. The loss on measurement of liability is 30,000 pesos. So the journal entry to record the transaction on December 31 would be debit on loss on measurement of liability na 30,000. This is an increase in liability. And then credit accounts payable of 30,000 pesos. Next entry would be debit accounts payable of 140,000 and then credit share capital of 110 of 100,000 and then credit the share premium of 40,000 pesos. Because when the counterparty chooses settlement in equity instrument rather than the payment in cash, the liability is transferred directly in equity as consideration for the equity instruments issued. So the next entry would be debit share premium of share options outstanding of 10,000 and credit share premium of 10,000 pesos. So the equity component previously recognized remains within equity. Only a transfer from one component of equity to another is made. So next, on scenario 2, on December 31, 20x1, ABC shares have a market price of 14 pesos per share and XYZ chooses cash settlement. So same pa rin naman po on how the liability component is remeasured to fair value on settlement date. So the journal entry to record the transaction on December 31 would be debit loss on measurement of liability na 30,000 and credit accounts payable na 30,000. Next entry would be debit to accounts payable of 140,000 and then credit cash in bank na 140,000. So that is because when the counterparty chooses settlement in cash rather than equity instruments, the payment is applied as settlement of the liability in full. And the last entry would be debit share premium, share options outstanding at 10,000 pesos, and credit share premium of 10,000 pesos. So next would be the deferred tax implications. The salaries expense recognized under share-based transactions may not be equal to the allowed tax deduction, and in such case, a deferred tax asset arises. A deferred tax asset is recognized if the entity has sufficient future taxable profits against which it can be offset. The recognition of the deferred tax asset is dealt with as follows. So if tax deduction is less than or equal to salaries expense, the associated tax benefits is recognized in profit or loss. And if tax deduction exceeds salaries expense, the excess tax benefit is recognized in equity. So let's have an illustration on deferred tax implications. So on January 1, 20x1, ABC issued share options to its employees. The fair value of the share options on grant date is 500,000 pesos. The share options vest in 3 years. ABC is subject to a tax rate of 30% and is allowed a tax deduction for the intrinsic value of the share options. So here in case 1, tax deduction is less than salaries expense. So the intrinsic value of the share options on December 31, 20x1 is 400,000 pesos. So to compute for the tax deduction on December 31, 20x1, we just simply multiply the intrinsic value of share options that is already given, 400,000, times the vesting period passed over total vesting period, which is 1 over 3. So the total tax deduction sa year 20x1 would be 133,333. Next, we're going to compute for the salaries expense on December 31, 20x1. So fair value of share options at grant date, that is 500,000. Multiply by vesting period pass over total vesting period na 1 over 3. So the salaries expense for 20x1 would be 166,667 pesos. So to compute for the tax benefit of the tax deduction on 20x1, which is 133,333, multiply natin sa tax rate na 30%. So ang income tax benefit na ma-recognize sa 20x1 profit or loss would be 40,000 pesos.
Thank you, Sir Erwin.
Thank you.
Revenue